Dom Guiliano, Portfolio Manager for Magellan Financial Group. Thanks for joining us.
Thanks for having me.
Today we're talking about Europe actually, and Mario Draghi back in 2012 calmed the financial markets down with his comment of doing whatever it would take from the European Central Bank. The European banks and the financial system have still got problems, but they bought themselves time, basically, from what I can see. Can you give us an update on where in the healing process the European financial system is at?
Yeah, they've actually made a fair degree of headway. If we cast our minds back to 2011, 2012, there were a couple of really important stresses in the system which were hurting the banks. The first was they were generally undercapitalised and they were probably under-reporting the amount of loan losses on their books, so they were under-reserving. And then secondly, you were seeing some very strong increases in debt levels in the Eurozone at the government level. So the sovereigns were becoming weak. And if you cast your mind back to that time, you had this sort of...
Sovereigns as in Greek
debt, the Italian debt, Spanish debt, all of those debt levels were increasing. And of course the banks own government debt, and there was sort of this almost a death spiral playing out where banks were getting worse, they owned government debt, the governments were so indebted they couldn't bail out the banking system, and it just kept on getting worse and worse and worse. And Mario Draghi kind of pulled the plug on that by providing a lot of cheap financing to the banks, and then also making the statement that they would do whatever it takes. So the first leg of the problems back then was banks were undercapitalised. The second leg was that the governments themselves were over-indebted and weren't in a position to help out the banks. So what's happened since, and what is happening? Firstly, the banks themselves have been given breathing room to increase their capital levels. So you've actually had something like 50 billion euro plus of capital level increases just over the last 12 months. So institutions like Deutsche Bank have increased their capital levels by 8.5 billion or so. You've had Monte Paschi di Siena in Italy increase their levels by 5 billion. And there's been a whole bunch of other banks as well. And also if you cast your mind back to 2011, 2012, you had other banks, Intesa Sanpaolo in Italy increased their capital levels by 5 billion, UniCredit by 8 billion. So all of these banks over a long period of time.
And how have they done that? Have they
they've gone to markets
equity?
And they've raised typically rights issues.
Right.
And they've raised equity levels. And now they're also issuing some Tier 1 eligible debt, which is called contingent convertible debt. So they're also increasing their capital levels in other ways. But there's another way which they've also improved their capital levels, which hasn't been so good, and that is they have been deleveraging.
Yes.
Okay, so banks in Spain in particular have been reducing their loan levels. German banks have been reducing their loan levels. Italian banks and others haven't been lending out as much as they should be. And that's actually causing general weakness in the economy. So part of that capital boost has actually been causing weakness in the economy, which then feeds back
into
the
lower
system.
Economic activity.
Exactly. So that's been playing out over a period of time. Now there's something important which is taking place across all of this, and that is that the European Central Bank is taking over the supervision of the 120 largest banks across the Eurozone. And that's really important because finally you've got the one regulator assessing all of those key systemic banks with the one view. They're not going to be protecting the Italian banks because they're the Italian regulator or the Spanish banks being protected by their regulator. You've got the one playing field, and that playing field will reveal itself in November of this year when the ECB takes over supervision. And so one of the first things which the ECB, the European Central Bank, is doing is they're conducting what's called an asset quality review. And also stress testing the banks. And that's to lift all of their reserving levels and all of their capital levels to the same level of assessment. Some banks won't make it.
And you're expecting that stress test to be different from the last round of stress testing, which was done by each jurisdiction, as I understand it, which was probably at best called laughable, I would have thought. So what's your expectation of that stress test?
It was, you're absolutely right. There were lots of question marks over the validity of those stress tests, whether they were actually strong enough. There were all sorts of national quirks that went on in the accounting. A whole bunch of weird stuff happened. and the markets didn't believe the adequacy of those stress tests and the subsequent capital raisings which took place.
Yeah.
The European Central Bank really doesn't have too many goes at this, and they've got to protect their own prestige in the market, and they have been very careful in the messaging over the last year and telling the banks that you better raise capital ahead of the stress test, because afterwards it'll actually be more painful for you, it'll be more costly for you to raise capital. And that's actually what you're seeing, and hence the numbers which I mentioned earlier, that you have seen 50 billion euro raised over the last little while. But even notwithstanding all of that, you've got some surveys by companies like Ernst & Young saying that maybe 25 to 30% of banks actually expect themselves to have to raise perhaps some capital.
Right.
Now, when we talk about the capital raisings, I think it's really important to distinguish between the largest banks out there and the long tail of smaller banks.
Yep.
A lot of the largest systemic banks that will come under the European Central Bank supervision have actually improved their balance sheets considerably through capital raisings and through deleveraging through asset sales.
Yep.
But there's a long tail of banks which really haven't done as much as they should. And you've got to remember that in places like Italy, France, Germany, the banking system is relatively fragmented. It's not like Australia, we've got 4 large banks and a couple of small regional banks. You've got something like 600 banks in Italy. Now, a lot of them are very small community-based banks, and you've got some very, very large banks. And the same sort of story plays out in Germany. And you've got the long tail, which is now probably a concern.
Right.
But that's still important, because if they're weakly capitalised, they're not as strong as they should be. They can't lend out to the SMEs. The local communities are weaker than they should be. That feeds back right into the entire economy, and that means that profitability and growth at the economy and at the larger bank levels isn't as strong as it should be.
Yeah. Okay. So to pull that together in terms of probabilities, because everything's a game of probabilities when talking about these things. Do you see the European financial system having another, let's call it another event, another bad event, as a high probability or a low probability given the repairs that they've done?
I think that's really become quite a low probability event. And you know, the ECB and Mario Draghi really showed their cards with it will do what it takes, and then putting together the outright monetary transactions capability. That still hasn't been tested, by the way. And
no, it's basically talk, isn't it, so far?
It's talk, and you know, our central bankers have got amazing talking power, but that still hasn't been tested at the German Constitutional Court level, and there's question marks around that.
Yeah.
But you've got to stand back and have a look at the general health of the financial system, and the regulatory backstops around it are far superior to the situation 3 years ago.
Yeah.
The issue now, so the bogeyman about capital levels, supervision, national debt levels has kind of gone, but there's something else which is kind of replacing it in terms of economic health.
Yes, yeah.
And that is the low rate of inflation, the low rate of economic strength that you're seeing in the Eurozone, and the lack of structural reform, meaningful structural reform out of the major countries, particularly France and Italy.
Yeah. And perhaps we'll talk about that in another session.
Absolutely.
Look, complex topic. Thanks for simplifying that and giving us some key messages about financial health of Europe. Thanks,
Pleasure.
Dom.